Hello and welcome to the Bazaar's webinar on business resilience during the COVID-19 pandemic. I'm Michael Jones and I'm a partner at Bazaar's in Melbourne and I'll be your host today. And the webinar is being recorded and it will be available to view later today using the same link. Now, before we begin the program, I'd like to point out the interactive features of the webcast player that you're watching right now. So just below me, next to the timeline, you'll notice a speech bubble. Now that is the ask button. So if you'd like to pose a question or comment at any time during this webcast, just click on the speech bubble and then you fill out the form and then click to send. Now we'll take your questions throughout the presentation. I suggest that you don't wait until the end of the presentation, as possible delays may make it too late to do your question. And I encourage you to provide your name and email address along with your question or comment. And that way, if we don't get to your question during the webinar, we can follow up with you later on. So now to our topic. The cost of the government's stimulus schemes to support the economy is enormous. Now, the need is urgent, the task of drafting rules is complex, the time frame is short and the implementation is challenging. But it's the right thing to do to keep employers and employees connected in a variety of ways. And it's important that they stay connected through the pandemic, but also into the recovery stage. Now, at Bazaar's, we recognise the challenges and we understand the policy, the rules, and the practical problems. We can help you navigate the issues and answer those curly employment law questions. Together, we can do it. This morning, to help along that way, we have two presenters. First will be Jamie Towers. Jamie is a partner at the Bazaar's Tax Consulting Division in Brisbane and an expert in the stimulus scheme rules. Jamie has the practical knowledge and the experience to help clients properly access the economic assistance and also to be in the best position in these uncertain times. And Jamie's presentation will focus on JobKeeper, but also on strategic actions to maintain business resilience. Our second speaker is Cheryl Ann Laird. Cheryl is a leading employment law expert and heads Bazaar's HR consulting division. Cheryl Ann has been working directly with our business clients, helping them manage the significant impact COVID-19 has had on the workplace. And Cheryl Ann's presentation will cover what businesses need to be aware of from that all-important employee relationship point of view. Now, we'll have room for a couple of questions in between the two presentations, just to get a couple of one in quickly. And then we'll have a second longer question time frame before we finish. But again, I say, don't wait. Send those questions in to me as soon as you've got them and I'll pass them on to the presenters. So now, Jamie, if I pass it on to you, for you to start your presentation.
Great, thank you very much, Michael, and good morning, everyone. As Michael mentioned, I'm going to take you through the JobKeeper stimulus package and look at what are the criteria for employers to be able to access the stimulus and what are the key things that you need to be doing right away to be able to access all of the valuable stimulus. So first off, I'll just have a very quick look at how the government has introduced the different stimulus over the last month, and it's been very fast moving. Every week there's been another announcement with more and more stimulus as the government has realised how serious this COVID-19 pandemic has become and how it's been affecting the economy. So we've had stimulus coming through all through March. One of the large the first stimulus was really the cash flow boost, and that was aimed at providing employers with 50% of the tax that they withheld from their employees from March, a minimum of $10,000 to a maximum of $50,000. And then the government will also provide that same amount in the second half of the year, so up to $100,000 tax-free to the employer. So that was sort of round one and expanded into round two. The third stimulus, which we're concentrating on today, is the JobKeeper payment. So that's what we'll be spending time on. So what is it? So JobKeeper, it's a federal government stimulus package. It's designed to keep people employed rather than businesses that are struggling making the decision to make employees redundant. The government is acting to help those businesses keep people employed rather than joining the Centrelink queue. And the reason for that is that government believes, and rightly so, is that if businesses can keep people employed, keep the business ticking along, once we're through these difficult times, if businesses have people employed, they'll be able to ramp up their operations much more quickly, get the economy going more quickly, and help the overall Australian economy. So what is it? So it's the main requirements are that businesses are paying a minimum of $1,500 per fortnight per eligible employee. And it will last from now, from the end of March, right through till the end of September. And it will occur as a reimbursement of wages. So the key thing is that the employer must be paying the wages to the employee first. And then after that has occurred, the government will reimburse the employer for those wages payments. As I mentioned, it will go from the 30th of March right the way through till the end of September. And I'll now take you through what employers need to be doing to be able to apply for the stimulus. So this is a very quick snapshot of the process, and I'll take you through each of those steps. So the first one was just registration. Now that was open a week or so ago. You no longer need to register for notification. You can now start applying for the stimulus. So what do employers need to do to be eligible? Well, first of all, they need to be in business on the 1st of March. So the employer, whatever type of entity it is, whether it's a sole trader, a trust, a company or a partnership, or a not-for-profit, they need to be in business and have an Australian business number, an ABN, on the 1st of March. And that business or that entity needs to have been lodging business activity statements or needed to have lodged a 2019 tax return showing that it does have business income. So one of the critical things is if you haven't done that, you need to get your compliance up to date. Lodge your BASs or lodge your tax return to be able to demonstrate you are actually in business. Now the next thing is the business needs to have employed at least one eligible employee on the 1st of March. So someone must have been employed at the 1st of March or had a business participant, and we'll go through what those are. So if businesses had taken the decision earlier and sacked all of their employees at the 1st of March, they're not going to be eligible. But as long as they had at least one employee on the 1st of March, that they will potentially be an eligible employee. We'll go through the eligibility criteria in a moment. Now, if you had an employee on the 1st of March, you need to continue to pay those eligible employees. So one of the first things is if you stood those employees down because there was no work, you can re-engage with them and start paying them at least $1,500 per fortnight to be eligible for this program. Now the business for the business to be eligible, they have had to have actually experienced or are projecting to experience a reduction in turnover. And I'll go through what that means. And then the final point is they're not an ineligible business. So certain businesses are not eligible at all, and I'll go through those. So the key thing that businesses are grappling with is a reduction in turnover. And what is it and what is the percentage? So the first percentage is in relation to charities. So ACNC registered charities, accepting universities and schools, must have had a reduction in turnover of at least 15%. Now, really big businesses, so these are businesses with an aggregated turnover of more than $1 billion. So generally it might be a multinational enterprise, or it could be a really big Australian company or organisation with many companies. You look at all of those enterprises put together. Is their aggregated turnover more than $1 billion? If it is, then each of those actual individual enterprises needs to assess their turnover, and if they've had a reduction of at least 50%, then they are eligible. Now, for all other businesses, if you're not a charity and you're not part of a group that's more than $1 million in turnover, then they must have or be able to demonstrate a reduction in turnover of at least 30%. And I'll talk through in a moment what is turnover. So turnover, for the purpose of these rules, is a GST concept. So if you include it on your business activity statement as business turnover, this is what they're looking at. So they're looking at sales. So anything that's really subject to GST is what they're being concentrated on. And also GST-free supplies. So if you're exporting, for example, that is part of the eligible GST turnover. What's not counted is what we call input tax turnover. So that might be residential rents, financial supplies, things like that. So it is a GST concept. If it goes on your BAS as part of your BAS turnover, your business activity statement turnover, that's what we're looking at here. Now there's two concepts or two measurements within this JobKeeper. So one is actual turnover, and we're then looking also at a historic measurement period, and then there's a projected turnover. So projected turnover is looking at, well, what are we reasonably anticipating the business's turnover to be in this current month or this current quarter. So at the start of the month or the quarter, what are we anticipating the GST turnover to be for that month? Now, one question we get a lot, how do we measure it? Is it a cash basis or is it an accruals basis? Generally, the government prefers it to be on an accruals basis, but if you are a small taxpayer and you are registered as a cash basis taxpayer on your activity statements, you can use cash to be able to measure your actual turnover or your projected turnover. So what cash am I anticipating receiving from customers over this next month or other periods? So how do I go about projecting my turnover? This is one of the key questions, because we're telling the government, okay, well, we believe we are going to have a fall in turnover compared with another period last year of more than 30%. How do I go about that, and what evidence do I need to keep? Well, I think businesses really need to look at their own industry, what the government's telling them, what they are seeing, what their customers are telling them. So if customers start pulling out of contracts, you know you're not going to get or being able to invoice that customer for that particular month or quarter. So you're using all that information to be able to forecast, okay, what's my turnover going to be for this coming month or for this coming quarter? Some businesses, it's going to be easy. So for example, the the gyms, the restaurants and things have had forced closures due to social isolation, it's very easy to show that you're going to have a big reduction in turnover. Other businesses that aren't forced to close but are nevertheless impacted, it might be a little bit more tricky to be able to forecast, but you need to take all available information and keep that information to be able to put into a forecast to project what that turnover is going to be. Now, one of the key things there is keeping the information. Now, the application, you simply need to notify the tax office that you're having a reduction in turnover. And the tax office may well accept that without any questions, but there will be audits. So you do need to keep the relevant information to demonstrate why you believe there is going to be a reduction in turnover. So what are the measurement periods? Well, this thing started, it started from the 1st of March. So the first measurement period, and we've finished March, you can actually measure what turnover you've actually received in March. So that's an actual measurement. And you can compare the month of March with the prior month in 2019, so March 2019. So you can either select a monthly turnover or a quarterly turnover. And it doesn't need to be the same as what's on your activity statements. So for example, if you are a quarterly BAS lodger, you can actually still forecast your turnover on a monthly basis for the purpose of this JobKeeper. You just need to keep those records. Now, if you're an early adopter and want to get this JobKeeper right from the start, you can either review the actual month of March turnover and compare it with March 2019, or you can look at a projected basis. So we're partway through April, so you can project what the month of April's turnover is going to be, or the June quarter, project that you're going to have a reduction in turnover compared with the same time last year of at least 30% or 50 or 15, depending what type of organisation you are. So the key turnover test is comparing it with the same period of last year. Now, one big question that we're getting asked is, well, I've just started my business. I wasn't actually around in March or April last year. What do I do? Well, the Commissioner actually has a discretion to accept another comparable period. And so the government has empowered the Commissioner of Taxation to have a discretion to look at alternate periods. Now, the tax office haven't actually released how they're going to do that yet, but we're expecting that shortly. But some of the guidance that we have, so when the government release these rules, they put out an explanatory statement, and that gives us some hints as to how the tax office might administer that. And one of the examples in that explanatory statement says, well, if you weren't in business in, say, April 19, what the Commissioner may do is look at your average turnover over the last, say, 3 or 6 months and use an average basis. And if your April turnover has fallen by more than 30% than the average of the last 6 months, then that may be an acceptable comparable period. So we're waiting on the tax office to release that information, but that's a good example of what the government has predicted will apply. So other questions we're getting. So we've already asked, what if my business was not going a year ago? So what if it was going a year ago, but had only just started? And so you might have started in February 19 and it only had very minimal turnover, and it's now had ramped up, but it's dropping again. Again, there might be a 6-month period that will be an average that you look at. What if my business was in a drought a year ago? So it didn't have much income, so it's not a fair comparison. Well, the tax office actually has discretion to look at perhaps a year before when you do have a regular income. And so all these rules give the Commissioner some discretion to make an appropriate comparison period. Now, the Commissioner has said that they will issue a legislative instrument with some alternatives, and we're expecting that to come through very soon. So let's talk about the eligible employees. So we mentioned at the start, they must have been employed by that business on the 1st of March. Next thing is they must be more than 15 years old, so 16 or older. Now, the JobKeeper is looked at in terms of fortnights. So was that particular employee engaged by the employer in a particular fortnight? So they must be employed and getting paid in each fortnight, commencing the 30th of March. Now, they must be either full-time, part-time, or a casual that's been employed by the business for more than 1 year. And they must be an Australian citizen, a permanent resident, or a New Zealand citizen that's arrived on a 444 visa. And then importantly, they can't be already in receipt of either paid parental leave, workers' compensation for incapacity. So they must be actually turning up to work. Now, a critical thing is that the actual employee must be nominated, and the employee must accept that nomination and provide the employer information in writing that they accept that they will be nominated. So the tax office have actually released a particular form that you can provide to your employees, and the employers can agree in writing that they acknowledge they're going to be subject to JobKeeper and are willing to accept that. Now, if they don't, well, then they're ineligible, and the employer will not receive that $1,500. So it's critical to be getting out these forms to the employees, having them sign them and return them, and the employer needs to hold these signed forms at the time they're nominating or applying for the JobKeeper. Now, another concept is that there's a lot of businesses around that where the main business owners aren't actually paid as an employee. So, for example, a sole trader, you can't employ yourself, but you are working hard in your own business. Now, the government has allowed one particular business participant per per business to nominate as a business participant. So for sole traders, it's the actual business owner. If you're in a partnership, the partnership is allowed to nominate one of those partners to be nominated as a business participant. If you're a trust, you must be an adult beneficiary of that trust. And if you're a company that has directors or shareholders that are working the business but not taking a wage, one of those people can be nominated as a business participant. And that business participant must satisfy all those eligibility criteria that we talked about for the employees. So more than 15 years old, Australian citizen, etc. So a quick example of this, we've got a husband and wife operating through a family trust, operating a business. They don't draw a wage. They just receive a trust distribution at the end of the year. Now, the trustee of the trust is able to nominate either the husband or the wife, not both, as a business participant. But a key question here is for these business participants, does the business actually need to pay that business participant? You would intuitively think yes, but the rules don't actually require that. So in this trust example, you could nominate either the husband or the wife. They don't actually have to physically pay that. So the profits could be distributed as per normal at the end of the year, and the business still receives the JobKeeper. Okay. I seem to have, here we go, ineligible businesses. So the final criteria was it wasn't an ineligible business. So the government is saying, well, we're supporting our own employees. So if the employer is a government agency or a corporatised agency owned by the government, then they're ineligible. If you're a bank, so a business subject to the major bank levy, the government feels that they have enough money to support themselves, they are ineligible. And finally, companies in liquidation or another type of business with a trustee in bankruptcy appointed, they are ineligible businesses. So they can't apply for the JobKeeper. So how do we go about applying? Well, there's you need to send off that JobKeeper employee nomination form to all of the employees who you believe to be eligible. So the employer must have an idea of who's going to be eligible, provide the employee with that form, and then the employee needs to sign it and say, yes, I'm eligible and willing to be accepted as an eligible employee. The business needs to pay those eligible employees at least $1,500 per fortnight for any fortnight that you want to claim for the JobKeeper. Then the next thing is either you engage your tax agent, for example, Mazars, to assist in applying for the JobKeeper, or if you're confident in what you're doing yourself, you can do it via the business portal using a MyGov ID. Now you need to nominate the period in which either the turnover has actually fallen or is predicted to fall. So it could be March, could be the April month, could be the June quarter, or you might actually get to a point where you think, well, actually I'm okay for this month or this quarter, but I think that my business will actually have a reduction in a later month. In that case, you can't apply now, but you can apply later. So for example, you might apply in July because you know that July month or the September quarter you're going to fall, and it starts from then. Now you need to confirm on the application that the turnover has fallen by the relevant percentage. You don't actually need to demonstrate to the tax office at that point in time how you've calculated, but you do need to keep those records because you can be sure there'll be audits in the future. So you need to nominate the expected number of eligible employees when you first apply. And also advise whether you've got a business participant that will meet the criteria. Then after the 4th of May, the government will open it up to the actual eligible employees. So at that point, you nominate the actual employees that you've got a signed nomination form from those employees. You've got their single touch payroll proving you've paid $1,500. Or if you're not on a single touch payroll system, you can nominate it on a tax office form. And then you lodge that with the tax office. Now, each month following your application, you need to be able to provide to the tax office your projected turnover for that month and the comparison period last year, and the number of eligible employees, or declare the actual eligible employees for those fortnights of that particular month. Now, the government is spending over $130 billion, or predicted to spend $130 billion in supporting businesses through this JobKeeper program. So they're giving it away with a simple application form. So how does it ensure the integrity? Now, so as an example, you've got a business with 100 employees. If that's eligible, that could receive $1,500 per fortnight, so twice a month, by 6 months, by 100 employees. That's $1.8 million. Significant support to businesses. Now, the government are going to want to make sure that they're getting value for money and businesses are doing the right thing by applying correctly. So the critical thing that businesses need to do is be able to support their application. You need to have valid information to support why you believe your projected turnover has fallen by that 30, 50 or 15%. and those records need to be kept for 5 years. Now, as part of the rules that were introduced into Parliament and passed within that one day, there were specific anti-avoidance measures. Now, those rules talk about businesses entering into a scheme to contrive access to the JobKeeper program. So if the business has done something to create a reduction in turnover, for example, or some other thing that shows that they are accessing the JobKeeper when perhaps they shouldn't have, well then that's the type of thing the government is wanting to stamp down on. Now, if that happens and you get caught under an audit, you'll be required to repay the stimulus. There could be penalties. Now, the penalties can range up to 75%. And it's actually, if it's deemed to be fraud, so if you're defrauding the government by falsely claiming this, it could be a jail term. So significant penalties to make sure that businesses do the right thing. So you've got to be very confident that you are projecting a correct fall in turnover and keeping those records to back that projection. If you're not confident, get advice from professionals who can help validate why your projections. Now, as part of this overall JobKeeper, so the government is doing it to make sure that businesses come out the other end of the COVID-19 pandemic. Once the economy is starting to go again, the government wants businesses to become successful. So businesses need to be taking steps and creating plans to be successful. So they need to be preparing business plans, preparing a realistic cash flow for the business, at least over the next 12 months. I'd be going further than that, but next 12 months is critical. Where's your cash coming in from? How are you going to attract new customers? How are you going to get back the customers that you've potentially lost? And all these cash flow models will help support your projected turnover. And it will help guide decisions now and into the future. So if you're doing a realistic cash flow and you can't see that you're going to survive very well with the current level of infrastructure, the current level of employees, perhaps you need to be making decisions now before you're giving away your hard-earned cash. So it's really important to create the business plan or update your business plan, update your cash flow model, look at how your business is going to survive. And in doing that, you can speak with your accountants, your advisors, but the key thing is communicating with all aspects, all the things coming into your business. So banks, they're being very supportive. So interest-free periods or payment-free periods to help support cash flows. Landlords, the government has introduced some new rules to prevent landlords kicking businesses out and to facilitate reductions in rent or deferrals in rent if required. Talk to your employees. They're going to be scared as well as to what's happening in the economy. So talk to them. Talk to your suppliers and your creditors, including the tax office. So if you owe money to the tax office, they're being very good at the moment in supporting businesses in making deferred payment plans. And talk to your customers as well. So, but don't forget yourself. So many businesses, we talked before about the business participants, you're not paying yourself generally a wage, you're paying yourself at the end of the year. Maybe you need to be paying yourself a wage. So if the business does struggle or go under, at least you've taken something during the year. You can't pay yourself a profit at the end of the year if you haven't got one. Now remember, there's director penalties. So if you fail to pay your pay-as-you-go withholding, superannuation or GST, the government can come chasing the directors of the company itself. So be cognizant of that and engaging with the tax office early to get into payment plans if need be. There might be other employment issues that Cheryl Ann will allude to later. The critical thing with this strategic planning, take advice early, get your records up to date to be able to support the JobKeeper, support finance applications, support ATO deferrals, get your records up to date. Now, it's an old adage is failing to plan is planning to fail, but it's so true during these times. But one thing that we're talking to businesses about, there's a lot of change happening at the moment, but can your business change positively from the lessons that we're learning right now? Are there things that we can do to be changing the business so at the other side, the business will become more and more successful? That's about it on the JobKeeper. So I'll open up to Michael to send me some questions.
Thank you very much, Jamie. I've got a lot of questions. I've selected just a few that try to be representative. There was a lot about the business participation measure. I think you've addressed it. Just one I might just put in now, and that is, if you are applying under a business participation method, do you need to complete the nomination form?
Yes, so there is a particular nomination form as part of the overall application. You do need to nominate a particular business participant for your business. So yes, you do.
But it's a separate pathway.
Yes.
Another question is, someone's asked is, are we required to pay superannuation on the JobKeeper component of our staff's salary?
Well, that's a very good question, and it really depends on the actual situation. So, for example, you might have employees that are generally employed on $1,000 a fortnight, and that's always been the case, and they're always entitled to superannuation. But if the employer is topping them up to by $500 so that they get the $1,500, so the employee wins by getting a greater wage, the employer wins by achieving the JobKeeper. The superannuation guarantee only applies to the ordinary times earnings, which is the $1,000 of their ordinary wages. It shouldn't apply to the $500 top-up payment.
Okay, good. It's a common query. I've got a couple on turnover, which we'll do now as well.
Sure.
So one is that if your turnover ramps up during the 2019, can you compare it to a later period between April and June 2020, say?
Yeah, great question. So the government has, the government, when they released the rules, so they gave the commissioner a discretion that if the normal period from the 2019 year wasn't a very good comparison, they did give the commissioner discretion to allow an alternate period. So it will really depend on the situation as to whether the change in circumstances warrants that alternate period. And as I mentioned before, the tax office are yet to release the legislative instrument and yet to release those rules around when they will consider those alternate periods. But there is provisions there to allow that consideration.
Okay, one more quick one before we go to Cheryl Ann,
Sure.
and that is, it's a person, a large part of their business was exporting to the US, and so they didn't pay GST on their exports. And so does that revenue count, as GST revenue for the purposes of determining, your drop in revenue?
Yeah, great question. And I actually had this very question last night from a client, and they've got a business here in Brisbane, and 100% of their turnover is export turnover. And because the turnover test is a GST test, that's looking at is the supply connected with Australia? And because it's the supply is originating from Australia, it is connected to Australia from the GST perspective. So yes, it will be counted for turnover.
Okay, we'll stop there, but I remind you that any questions we don't get to, we'll answer directly. So now I'd like to hand over to Cheryl Ann Laird, our employment law expert here at Mazars. And because I know that employment law has been a really difficult area for people dealing with these things, and so there's been a lot of interest in what you've got to say. So Cheryl Ann, could you please start now?
Hey, thank you. Thank you very much, Michael, and welcome to everyone who is out there on the webinar. As Michael said, I'm going to talk to you about the employment relations issues that arise under JobKeeper. Okay, now look, the first thing I want to get people to think about is that JobKeeper is a wage subsidy. So it isn't money that belongs to the employer, it is money that belongs to the employer, not the employee. And I think if you keep thinking about it as that wage subsidy, it makes it easier to understand how the changes to the Fair Work Act, which have been made, operate in practice. So the whole purpose of the JobKeeper scheme is to enable existing employees to remain in work. Now, it might not be full-time work, it might not be the hours they had before, but it is to enable those who currently are working to continue to work. It's also intended to enable employers who in the past have had to stand people down or make people redundant to have the opportunity to bring those people back to do some form of work. And finally, it's also to keep employees who don't have the opportunity to come back into the workforce at the moment, who have been stood down, particularly, for example, in, say, the restaurants or the hotel industry where there may not be work of any kind available to them, to get some financial support through their employer to keep the connection with their employer, so that when we get to the other end of this, people can come out ready to recommence their businesses and to get back to full strength as soon as possible. So the employment relations aspects of the JobKeeper have arisen in the context of changes to the Fair Work Act. The changes apply only to those employers who are eligible for JobKeeper. If you are not eligible for JobKeeper, there are still opportunities for you to make some changes to your workforce under the Fair Work Act. It is just not these JobKeeper particular arrangements. So what are they? What can an employer do now to help them manage their workforce during this crisis, to continue with as much work as possible, but also to support their employees who perhaps aren't able to work? There is two sets of arrangements. The first one is JobKeeper enabling directions. So these are directions that employers can give to their employees to enable them to continue to operate the business. But before you give these JobKeeper enabling directions, you still have to consult with your employee. You still have to talk to them about how these things might operate for them, if perhaps they might have some different ideas about how you might be able to operate, what that enabling direction might say to actually assist with the business. Okay, so you must consult. The direction that you give must be reasonable in all of the circumstances. And we need to keep in mind that all of these job enabling directions will come to an end under the Fair Work Act amendments on the 28th of September. So these are not ongoing amendments. These are just things that we are able to do during this 6 months to assist our businesses. Okay, so what can we give directions about? The first one is alternative duty. So we always need to be able to give people useful employment, but we may not be able to give them the same work that they had previously. So we can actually direct employees to do alternative duties, provided that those alternative duties are within the skills and experience of that employee, and that they are within the scope of the employer's business. So we can't decide that we want our employees to come and clean our houses. We can't decide that we want our employees to be directed to go and work for a charity. It has to be within the scope of your business and it must be safe. So in terms of safe, one of the primary requirements at the moment is that people are able to continue to do the social distancing in the work that you might make available to them. And of course, if there is a licence or a qualification needed to do a particular job, you can only direct employees who have that licence or qualification to do that work. So an example of that is you might have less office work that you need doing, but you might have more work to do in your manufacturing side of your business, and you've got a manager who just happens to have a forklift licence. Now that manager can be asked to jump on the forklift and assist in the manufacturing because they have the licence to do so. But they couldn't be asked to do that if they didn't have that licence, even though they might have previously had a licence. They might say they know how to do it. So just make sure that you're looking after the welfare and the health and safety of your employees and the workforce more generally. You can also, the second kind of direction we can give people is to work from a different location. Now, at the moment, essentially that will be to work from home, but it might not be for every employer. An employer may have more than one office and may have elected to close one office and have everyone work out of the second office. You can direct people to change locations provided that to work from the alternative location does not involve unreasonable travel. Okay, but as I say, most of the time that is enabling people to work from home. Now, the third one, and perhaps the most important one, is the ability to stand down a worker on a day or a part of a day that the employee would normally work. Now, you can only do that if you do not have useful work for the employee to undertake at that time. Now, useful work doesn't necessarily mean their old job. It means work that is of value to the business, essentially. You can reduce their hours on a particular day, or you can reduce the days of the week, or you can actually stand people down for extended periods of time. So you can, in fact, issue a job enabling direction to do that. It is important that employers understand that when you stand someone down, they continue to accrue their entitlements. So if you had an employee who you stood down for 6 months, when they returned to work, even though they had done no work in the interim, they would have an additional 5 days of personal leave, an additional 10 days of annual leave. So in addition to the ability to issue directions which employees must comply with, there are also the capacity under the amendments to the Act to make reasonable requests from employers to their employees. These reasonable requests, where they're different to perhaps what might have happened in the past, is that an employee must not unreasonably refuse the request. So it is not a direction, but it is one step up from a direction. An employee would have to have a very good reason to refuse to comply. Now, the first one is to change the days or hours on which they work, provided it does not reduce actual hours. So if you want to reduce actual hours, you have to use the stand down direction. But it might be, for example, you have a part-time employee who normally works 3 days a week, and you would like them to move one of those days to an alternative day. That's changing the days on which they work. You might want to extend from a 5-day week to a 6-day week and spread your staff out across the 6 days. So people who move from a Monday to Friday to work on the Saturday would be given one of these requests. The other request that can be made is that people take their annual leave. Okay, a request can only be made where the annual leave that is taken leaves the employee with a balance of 2 weeks of leave. Okay, so we can't ask them to take all of their accrued leave, but we can ask them to take leave down to an accrual of 2 weeks. And there is also the capacity for employees and employers to agree that employees can take twice as much leave at half the pay. So essentially they will take 2 weeks off, we pay them half in the first week, half in the second week, and their leave accruals will be reduced by the 1 week not the 2. Reasonable requests should be given with at least 3 days notice. However, if the employee agrees to a shorter notice period, then that is okay, as long as they agree. Should there be a situation that arises where employers and employees are unable to reach agreement, those kinds of disputes will be resolved by the Fair Work Commission. And finally, the thing that people keep asking me about, and it's, Jamie has covered a little bit of it for us, is what happens in practice. So where an employee has no available work, you just cannot find any useful employment for them, you pass along the $1,500 per fortnight, and those employees do not receive any superannuation on that amount. But you also might have employees who are able to continue to work their full hours. In those cases, you would pay them as normal. And remember at the beginning I said think about the JobKeeper as a wage subsidy, so the employer simply keeps the $1,500 as part of the wage subsidy and pays the employee normally for every hour that they have worked. And in that case, they would get superannuation on their ordinary hours, on all of those hours that they worked. And then as Jamie went through with us, where they work less than normal hours, I think it's easy to think about that we pay them superannuation on hours that they actually work. So if they work less than the number of hours that attracts a payment of $1,500, they get paid superannuation on that lesser amount and not on the difference up to $1,500. But if it's more than $1,500 and they've actually worked those hours, then they get paid superannuation on those hours because they are ordinary time earning. So there's lots more in the employment space, but I think that that's probably, Michael, my time.
That's right, it is your time, Cheryl Ann. Thank you very much. We've got loads of questions. There's no way we're going to be able to answer them all on this webinar, but we will answer them all after the session. I might start with one for you, Cheryl Ann. We have an employee who's commenced maternity leave in February with the intention to return in November, and the baby's born in March, and she hasn't received any Centrelink payments yet, but she'll get it in May. And the question is she entitled to JobKeeper for the period up to when Centrelink payments start?
Now this might be one that Jamie might also be able to help with in terms of the eligibility, but my understanding is that if there is any period of time for which she is not receiving government payments and she is otherwise eligible, she should be able to be in receipt of the JobKeeper $1,500.
Yeah, the rules aren't very clear on that, but that would be my view as well.
Okay, good. Thank you. Cheryl Ann, another one. With the needing to have 12 months, does that only relate to casual employment, or does it also relate to the full-time, part-time employees as well?
No, it only relates to casual employees, and those casual employees need to have been engaged for 12 months on a regular and systematic basis. And most employers would be used to that concept. It's been around in employment relations for a long time, the difference between a short and a long-term casual. Okay,
Though it's been around for a long time, but sometimes it's confusing. But anyway, moving on. It's a lot about turnover, Jamie, so I'll ask you one now if we can get it quickly. It's about what if you satisfy the turnover test in March, but then subsequently, what you satisfy is the lack of turnover in March, but subsequently your revenue increases. What happens then? Like, do you stop JobKeeper or what happens?
Yeah, great question. So if when you're applying, so if you're benchmarking the month of March as an example, and you nominate to the tax office, apply to March, you can support the fact that your March turnover has reduced. That's it. Once you're in, you're in. Now, a business can actually notify the tax office that they do not want to participate in JobKeeper any longer. But if you don't do that, you'll continue to get the JobKeeper. Now, the business does have to provide monthly turnover to the tax office, but even if it does show that there is no longer a reduction in turnover, they continue to be eligible and will receive the JobKeeper allowance.
Yes, because it's really showing that the policy is working.
Yes.
Okay, but then what is in the other way around? What if the revenue's down now, but later it will increase? So does that mean you apply later, or what happens in those circumstances?
So it's dropped by 30% now.
Sorry, I got it wrong.
No, the other way.
You don't satisfy the drop now.
Yep.
But you will satisfy the revenue, the turnover test later.
Yeah. So for example, you're travelling along okay, or you might have had a fall in turnover by only 10% now, but you think that come July you will actually satisfy that drop in turnover then. So yes. In that particular situation, you can nominate based on the projected turnover for July onwards, and you would only receive the JobKeeper from that July period onwards. So you wouldn't receive it from April to June, but you would receive it for the period when you do experience that significant drop in turnover.
Okay, and one more for you, Jamie. With the JobKeeper payment, is it taxable to the employer? Like, is it taxable to the employee? What's its tax character?
Yes, so a great question. It is actually taxable to the employer. So when the employer lodges its tax return at either 30 June 2020 year or the 30 June 2021 year, it will need to include those JobKeeper stimulus payments from the government in its taxable income. But from a net basis, it can continue to deduct any payments it makes to the employees as valid tax deductions as well. And perhaps a follow-up on that, Michael, I have been asked whether the employers have to withhold tax from the payments that they make to the employees. And the answer is absolutely yes. They treat it just as any normal wage and withhold tax from those wages where appropriate.
Okay, so this might be for Cheryl Ann. How does JobKeeper deal with family tax allowance?
Oh, I really think that's a Jamie question.
And I'll pass on that one as well. It's
okay. We'll come back to them. We'll come back to them. All right, that's fair enough. Yep. So one of the questions is, what happens? I'll see who wants to do this one. Can you apply as a business participant if you're also employed somewhere else and your employer is not nominating you as an eligible employee?
The answer to that would be yes. So you are only able to claim the JobKeeper for an individual in one situation. So if you are employed elsewhere, but that particular employer doesn't nominate you for the JobKeeper, then you can still nominate yourself as a business participant. But if you have been nominated by someone else, then you can't claim it as a business participant. Similarly, if you've got two different jobs, you can only, as an employee, you can only accept to be nominated for one job only.
Okay, good. I think there's many questions. We'll respond to them individually. And I think for now, we'll need to finish this session. So thank you everybody for joining us today. I want to draw your attention to, on our website, we have a COVID-19 resources page, and the reference is there on the screen. And also, If you require support managing your workplace and your employees during this time, well, we do have a support package available which Cheryl Ann provides, and it's very good value. You'll receive an email after this session with all these sort of details. And finally, and most importantly, I just want to reiterate that we're here to help you through these challenging times. You know, it's significant money and very critical relationships that are at stake here. So let's work together and let's get it right. So I encourage you to contact your advisor or one of our officers for assistance. Very good. Thank you very much. Goodbye for now.